morning, everybody. It's Friday, June the 4th. So we're all the way through our first 5 months of the year. And a reminder, I'll remind you one more time, this will be our last show for the summer. Mallory and I are going to take a little bit of break to cover some vacation and some training and some technology issues. And then we will be back on August the 13th. But today will be our last one. We have a lot to cover. So let's jump right on into it. I really appreciate everybody joining us. And it is Market Insights with Mike. I'm Mike McCauley. And with me is Mallory Vaughn. So what's going to happen over the next couple of months? Well, the FOMC is balancing a lot of balls right now. Any talk of inflation, they have to start looking at what do they want to do. They committed to holding interest rates where they are through into the first quarter of 2022. They're going to a lot of pressure to change that. So the FOMC is a group of people with a lot of balls to deal with, and they have to try and keep all of them in the air and all of them working. So I think the summer is going to be kind of a balancing act for them. The inflation is going to be an issue for them. Do they want to raise interest rates? Do they want to combat inflation? They believe inflation is going to be short-lived. I tend to believe that's probably true as well. And the fact is that the inflation is pent-up demand. Economics is supply and demand. We've been pent up for 15, 16 months, and now we're able to get out. So there's going to be demand for goods and services, which is going to increase the price. I think our biggest issue is gasoline. That always goes up, starts going up Memorial Day. It'll peak 4th of July, and we're seeing 3, 4. We're going to see some $5 a gallon in some parts of the country. But all through the summer, the FOMC is going to be balancing those balls and trying to keep them in the air, and that'll be interesting for me to watch from the sidelines, and then to get back on in August and kind of summarize what we've done. Let's see here. We have our indices year to date. Now, this is really important. So we've gone through 5 months. Where are we? Dow Jones Industrial Average is up 13%. The NASDAQ, which is the high tech, is only up 5.6%. And the S&P 500 is up 11.6%. And remember, this is starting to sound like a broken record, but we've been saying all year, the fact that NASDAQ is heavy tech and we didn't think it would perform as well as it's done the last 8 years, that's holding out and proving true. The interesting part about that is what's in those is the memory chips and the processing chips, which are holding up production on cars, televisions, DVDs, pretty much anything. My youngest son and I went to a computer store last weekend, and it was amazing to me to walk down the aisles and see empty shelves, meaning there's no product in there. So that's technology. It's getting hit pretty hard, but still take that and roughly double it, and that's the pace we're on. So Dow's up about 26% annualized. NASDAQ's up, not quite 12%, and the S&P 500 is up about 23%. So on a pace, we're actually doing really, really well, quite comfortable. And we'll see how the summer takes us. We used to have a thing where we said sell in May and go away. That started proving untrue a couple of years back. And so we'll keep an eye on it and see how it does this summer. This is our unemployment claims. These continue to go down and continue to drop. And remember, my number is I'd really like to see that at about 200,000. That is a very reasonable pace. 200,000 sounds like a lot, but what it actually is about 5% unemployment. Here we are. We've dropped again. We're down below 400,000. We have jobs report is going to come out later today, and I have not gotten it yet. If the expectations are that we will add 656,000 jobs, so the job look is actually looking pretty well. That blue line or that aqua color line is about halfway down to where I want it. So we need to go down a little bit more, and that orange pace is dropping nicely. But I'm going to be completely honest, to get that orange line down to where it was in February or March, it's going to take us a year, 18, 24 months, just the averages of math. It's going to take that long. So pay attention to that aqua line, and it continues to decline, and it's doing really, really well. And again, I think that as the states cease or suspend their $300 supplemental unemployment, I think that number will continue to go down. With the $300 weekly supplement, someone's making basically minimum wage on unemployment. When that dries up, there will be jobs to be had, and there are jobs to be had now. And this is our Dow Jones Industrial Average. We have seen a little bit of a slip, and you can see back here, you go back a couple of weeks and start to flatten out, but it's really not flattening out too much. It's still kind of creeping on up there. And if you look where we were 12 months ago and where we are now, this is still a solid, vibrant stock market. And I don't see any real indication that we need to make any dramatic changes. Obviously, we don't have any control over huge surprises. But right now we still are growing growth at a reasonable pace, something that I'm comfortable with. We have stepped back from technology. I've said that a couple of weeks ago. I've said it for a couple of months. And but generally we have a strong market. And we used to say where the market and the economy were tied 1-to-1. That's not really happening anymore. They're kind of separate. And those of us that study economics are looking into it to try and figure out exactly where the conduits are and what the similarities are, and see how we go going forward. You know, I've said before that our children and our children's children will be studying 2020 in economics someday. That will be a watershed year in what happened. So it'll be interesting going forward. But right now, nice, strong economy going forward in the market. Volatility index, boy, this still looks like a heartbeat, doesn't it? And it keeps dropping. Again, I'd really love to see it down about 10, but we'll have an upbeat and we'll have a downtick. And generally the moving average is down. And this is basically a reflection of you, the consumer, where you are, what you're thinking, and it measures how we're going. So we could go back and we can kind of predict where the market's going to go based on this. We can see bad days. But right now, as far as this, consumer confidence, those are all pretty good numbers. They could be better, but generally they're pretty good numbers. A lot of this volatility and consumer confidence, I kind of relate it to knee-jerk reactions. You're always going to see some of that. But for now, the volatility index is a nice spot to begin summer. And as more of us, we're getting rid of masks, we're starting to travel. My son was on a flight last week and he said it was packed. So we are getting out, we are starting to move, and that's actually good for volatility. It's good for consumer confidence, it's good for the economy. Next. Our Treasury yields, we ended the month, right now we're at the 10-year Treasury. My computer's not giving me it yet. There's 1.601 today, and then the 2 years at 0.15. Those are not great numbers, but remember what we're looking for. This just supports what the FOMC has said, which is they're going to hold rates low. You can see the spread, and I talked about that. That spread is a good thing. We want that spread between 2 and 10 years. Somebody investing for 10 years needs to get rewarded more than somebody that's just investing for 2. So that's a nice number to see. And obviously, what we don't want to see is any drift back here to where we have this reverse, and you see the 10-year meet the 2-year. I don't see any danger of that right now. So Treasury yields have a nice spread. They appear solid, they appear stable. And so we're going into the summer with that happening. Now, the FOMC has stated that they're considering stepping back their purchase of corporate bonds. That may help yields, and we'll see how that goes. So this is our U.S. sectors. Mallory has added color, which is always helpful. And then you can see oil and gas and energy still leading the way. Number 1 last week, number 1 this week. And then you've got down at the bottom, you've got number 9 is telecommunications. I mean, it just hasn't done well. So I find that really interesting because telecommunications really is how we've talked to each other and how we've dealt with each other, how we've interacted the last year. So I really expected that to be doing better. I also expected healthcare to be doing better, 5.1%, but those costs are being kept down, and that's an interesting thing to see. Now you're back to basic materials and financials. So the 3 things that I've always talked about is that you're always going to see an increase in financials. We'll always need it. We'll always need healthcare, and we'll always need some consumer services. And those are doing very, very average, except for basic materials, which is being shored up by the housing market. So those are our sectors and how we're doing. No big exciting things going on. They're pretty quiet. So this is our world markets, how we ended up as of the close yesterday. And you can see on the far right-hand side, 2021 year to date. And again, multiply those by 2, and that gives you to an annualized return, pretty close to it. Those are all really solid numbers for 2021. If nothing happens, what we call ceteris paribus conditions, nothing changes, then we have some reasonable numbers go there. The UK had a quiet week, but so did Hong Kong, Singapore, and quite honestly, the Belgium, which is commodities. We use that for commodities. The NASDAQ dropped a little bit, S&P 500 dropped a little bit, but when you look at the year to date, those are really good numbers. 13% on the Dow, multiply that times 2, 5.6. We talked about that a few slides ago. So world markets are stable, nothing to freak out about really. And remember what we talked about Don't look at the trees, look at the forest. How are we doing year to date? And those are actually pretty decent numbers. So as we go into the summer and before we take our vacations, I want to talk a little bit about SWOT, which is strengths, weaknesses, opportunities, and threats. And this is kind of what we here look at when we're managing assets and we're making decisions on trusts and investments and asset management. What do we look at? And the strengths that we see are we're looking at companies that are able to redesign themselves. With the exception of Amazon, which seems to just have this goal of being everything, a lot of the other companies have had to change what they're going to do. A lot of that has been in the retail division and the leisure and entertainment, how they're going to continue to service and be able to do it and contain social distancing and be able to abide by federal law and state law, which are different. A lot of states have suspended the mask. However, Christopher, he was required to wear a mask in the airport, on the plane, and the airport he was going to. So that's a federal law that supersedes the state law. Consumer confidence is high, that's a strength. And the population is returning to normal activities, that's a strength. That helps with confidence, that helps with volatility, that helps with a whole lot of things. The opportunities is we have a strong equity market. I talked about that a second ago. Companies have trimmed costs. They've learned how to, and I got to be honest with you, that doesn't have so much to do with COVID as it has to do with a typical business cycle where companies go through, they get a little fat, they have to cut back because of the economy. That's normal. So they learn what they can cut, what they can't cut, maybe departments they don't need, maybe departments that they can change. And that generally is good for the bottom line of any company. And then you have industries that were hurt by the pandemic and are recovering. Yes, we talked about a K recovery a couple of months ago. They're all recovering at a different rate. That's not that abnormal. The ones that hurt obviously are still retail, travel, leisure, those are getting hurt, but some of the others have recovered pretty strong. For weaknesses, obviously are low interest rates. Everybody wants a low interest rate when they're buying a house, but they want interest rates to be high when they're buying a CD. Unfortunately, those go hand in hand. So when we have low interest rates, that there's a good and a bad side. It's a double-edged sword. We still are dealing with the new administration regulations, international relations, what they want to do. We'll see how this taxing goes, and then what effect that's going to have. And then the threats, the weaknesses and the threats are obviously the negatives. Long, low-term interest rates makes it very difficult for someone who's just a CD buyer and just sits on fixed income because they don't want stock market risk. Makes it very difficult for them to maintain their assets with low interest rates. And because of that, sometimes investors change their risk tolerance. They say, well, I want to get into the market because there's a better yield on some of the equities. That's true, but they're not really ready for the risk. And that's something that has to be managed. And then inflationary fears. I think that's the one thing that is extremely a knee-jerk reaction. For the inflation to go up 2.1, 2.3, 3.1%, I don't really have a problem with that. There has to be some inflation to allow for growth, to allow for increase in income, to allow for sometimes for those interest rates to pick up a little bit, allow people to make some money on their money. So I'm not too worried about inflation. I worry a lot about deflation. I don't think we're going to see that. And I worry about inflation when it starts hitting 4.5%, 5%. Then I start worrying a little bit more. But where we are now, I think there's some health to that. But we do consider a threat because it is so reactionary. So those are things that we look at coming up this summer. Today we'll have non-farm payrolls. Unfortunately, we won't get to talk about that next week. Don't forget June 20th is Father's Day. And that's one that, you know, dads and sons, I miss my dad. And tough day to get through, but that's coming up. July 5th is our federal holiday, Independence Day observed. Remember last week we talked about the federal law that moved holidays to Mondays. 4th of July is on Sunday this year, so the July 5th is a Monday. That's the holiday. Banks are closed, we're closed. And on August 13th, Markets Insights with Mike returns. That's our plan at this point. We really appreciate everybody being here. We've love seeing the names. I see a new name up here today, which is really exciting. Nice to see him. And we'll be back on August the 13th. Mallory will be sending out some invitations, making sure everybody knows about it. If you have questions, we're always here, 913-259-2110. Have a super summer, stay safe. Really thank you for joining us, and we look forward to seeing everybody again in August. Have a great summer. Take care. Bye.